Hello and welcome to another episode of Co-Founder Chats. My name is Ryan Correa, co-founder at Equivesto, and I'm here today with our industry expert and fellow co-founder, Alexander Morsink. Today, we're going to be talking about registered funds and everything private companies. So Alex, kicking things up, what are registered funds?
So registered funds are essentially, it's an umbrella term referring to things like an RRSP, a TFSA, a LIRA, different accounts like that. RRSP stands for Registered Retirement Savings Plan. There's a number of other accounts that also start with registered. And so registered funds refers to any investments being made within one of these specifically registered plans. Now, all of these plans are essentially special investment or savings vehicles that you can put your funds into, and then from those, make investments that are going to either defer or remove any related taxes from those investments. Now, we're not tax advisors, so please seek legal advice and tax advice around specifically the different accounts and how they should work best for you. But essentially, with an RRSP, what you're doing is you're taking a portion of your income before tax and separating it aside so you can start investing it right now without having tax sort of removed from it, with the idea being when you eventually retire, you can then start taking the funds from the RRSP account and you'll have tax charged at the time when you withdraw it. But because you're retired, the idea is your overall lifestyle and your income has gone down in your retirement. Your costs have also gone down, and therefore your marginal tax rate on that income is also lower. Just to avoid a few misconceptions, you can have as many different RRSPs, TFSAs, LIRAs as you like. You don't only have one RRSP at one location. An RRSP is just a type of account to hold your money in. You can have lots of checking accounts. You can have lots of savings accounts. It's the same with RRSP and TFSA. And the RRSP or TFSA itself is not an investment. I know both of them have savings in the name, but often the best use for these accounts are to be making investments from them. And just by putting funds into them doesn't mean you're automatically already invested. For some corporations, they might offer, for example, an RRSP matching program or something to employees. In those situations, they might control where the investments are made, but investments are still being made. But certainly for any self-directed RRSPs, self-directed meaning you as an individual are choosing the investments that are being made, you're able to, within that RRSP account, choose different investments and actually select where you want your money to be deployed. It's not just sort of one place and you put the money in and forget it. It's certainly an area where you can be going and choosing and making your own investments. Now, the big thing to keep in mind is only certain investments are TFSA or RRSP eligible, and that's where things become a little bit more complicated. The TFSA is similar to the RRSP in that it's a special account where you can make investments from. You can have as many as you like. What's different about the TFSA, again, this is not personal tax advice, the TFSA actually is tax-free. I know it says savings account again, tax-free savings account, but it's really also for investing. And the idea is any funds that you put in here and you're investing from this account, you don't have to pay any sort of taxes related to those investments at all. So you could put your funds in there, you could make investments, generate great returns, and then withdraw the funds and not have to pay any taxes. Something that a number of people also don't realize about TFSAs is when you withdraw anything from your TFSA, that increases the amount that you can put into the TFSA again the following tax year. So for example, if you put $20,000 into your TFSA, you invested it, it made some great returns, and you now have $30,000 in your TFSA, and you want to withdraw that to go on a trip or buy a car or add towards a down payment on a house, the following year, your TFSA contribution room will go up by the $30,000 that you withdrew. So for example, if you keep adding and adding to your TFSA and you make a lot of great investments, your overall contribution room will go up when you withdraw the funds there. So you can start having more and more funds inside the TFSA, even if you're taking money out to use it and deploy it. However, it's also important to keep in mind with any funds that you lose inside the TFSA. For example, let's say you have $5,000 and you make an investment and the whole investment sort of goes bad and it becomes worth nothing somehow. In that scenario, you wouldn't then gain that $5,000 worth of contribution room. Now, how do you know how much you can put into a TFSA or RSP? This is where you should speak to your own tax professional. But essentially, the government has an amount that you're allowed to put into the TFSA every year. All adults over 18 are allowed to contribute the same amount every year. And the amount started either when you first turned 18 or in 2009 when the TFSA was introduced. So there's a certain contribution room that's allowed every year, and it adds up to a total contribution room for your lifetime or since 2009. With the RRSP, it's a contribution room on an annual basis based on your income from that year. But again, speak to your own tax professional on that.
Thank you. What are some other common types of registered accounts?
So beyond RRSP and TFSA, you also have a registered education savings plan, which allows you to put some funds towards your children's future education. Similar type of thing to an RSP. You have a first-time home buyers savings account like a TFSA, but for saving towards a home. You also have a RIF and a LIF, which stands in for locked in fund, and a registered investment fund. Essentially, once your LIRA and your RRSP, once you've reached retirement age, instead of putting funds into them, you now need to start taking funds out. And that's what the LIF and the RIF are for.
How do people typically use their registered accounts?
Typically, people have a registered account that's connected somehow to their employment. And every year they take a portion of their income before tax, put it in there, and it might be sort of automatically managed by their employer, or they're working with a financial advisor who is buying a sort of basket of different mutual funds available in the stock market. But a lot of people don't pay super close attention to what's going on inside their RSP. They usually just put funds in there and then don't think about it much. They also sometimes might be confused and think they can only have one RRSP account. So they have basically this one with their employment, and they don't, open another one or do anything else separately because they think they can only have one.
Can private investments legally be within a TFSA or RRSP?
That's a great question. So for a type of investment, for any single investment, the investment itself has to be confirmed as eligible to be held inside a registered account like a TFSA or RRSP. All public investments are automatically eligible to be held inside those accounts. So for a lot of people, they think only public investments can be held in those types of accounts. However, certain private investments can be confirmed as eligible, and then they can also be held in those accounts. Now, it is the responsibility of the institution holding your TFSA or RSP to verify if the investment is eligible. So it's not just, oh, this investment has the right paperwork to confirm it's eligible, I can hold it in my RBC or TD RSP. It's that those banks, those institutions have to be willing to do the work and collect the paperwork to verify and then hold that investment inside the TFSA or RSP. What that typically results in is the big five banks and many of the insurance companies are not really interested in doing any of the work to hold super small private investments inside RRSPs and TFSAs. Also, many of these institutions sell a lot of investment products that their clients inside TFSAs and RRSPs can invest into. And it is often in their best interest to have their clients only invest in the TFSA RRSP products that they have created and they and their subsidiaries earn fees on. We don't often see as much in Canada people with one of the larger institutions offering different investment opportunities and investment vehicles outside of ones that are within their umbrella. For private investments, you can make different private investments eligible for TFSA RRSP. There's essentially two paths to making a private investment eligible. The first is a private corporation that's operational, sort of with employees engaging in business, bringing in revenue and having expenses. That can be confirmed. If that can be confirmed as an operating Canadian business by a lawyer or an accountant, then that can be confirmed as eligible for a TFSA or RRSP. The second option is also a mutual fund trust. So a mutual fund trust is essentially a trust as a legal entity. So a trust, kind of like when you hear about kids being trust fund babies, this is the same type of legal entity. So you have a trust, which is where the investors are investing into, and then that trust in turn invests into an underlying fund, which would typically be a limited partnership with a general partner managing it. That type of structure is also, again, when confirmed by the right tax professionals, eligible for TFSA or RRSP investing in the private space. Now, we just said that the larger banks don't often go through the work to verify those two types of private businesses as being eligible. So who does this work? Well, there are private companies, private financial institutions called trust companies. Now, that's different than a trust as a legal structure, which is that sort of trust fund that's at the top of the mutual fund trust. These trust companies are essentially financial institutions whose job is to be custodians and manage funds on behalf of other people. And they are the types of legal entities that can manage registered funds and TFSAs and things like that. All of the large big banks have these trust entities as subsidiaries in their huge network of companies that they own. But there are some standalone private trust companies that also offer this service. A few of them in Canada are Olympia Trust, Western Pacific Trust, Odyssey Trust, Computershare. Those are some of the examples of Canadian private trust companies. As an investor, to be able to access private investments via your TFSA or RRSP, you would need to open an account with one of these trust companies. And that specific trust company would have also had to have been the one to do the work verifying that that underlying investment you're interested in is eligible for TFSA or RRSP investing. In Canada, because Olympia Trust is the largest, most investments work with them. Also because most investors already have an account with Olympia Trust when the investors are active in the private investment space. And so it's sort of a self-fulfilling cycle because everybody's already there. More people keep coming to Olympia Trust to try to make life easier for themselves. As an investor, you would have to go and work with your exempt market dealer like Equivesto, the online platform where you make the investment. And then you'd also have to have an account with the trust company where they're going to be the custodian of your RRSP or TFSA. And then you can make the investment using both those two entities. Now, it's important to note that trust companies typically charge fees for their services. There's typically an account fee and a transaction fee, and there will probably also be a withdrawal fee at the end of the investment. Just like any other TFSA or RRSP, if you hold a private investment inside one of these TFSAs or RRSPs, you put the money into the account, you make the investment from that account, and then all of the returns from that investment go directly into that specific TFSA or RRSP. So if you make a number of investments, at the end, you'll have the value of all those investments and their returns inside that same TFSA or RRSP.
What is a trust company and why are they necessary?
So a trust company is essentially a legal institution. It's a financial institution that exists to help manage the funds of other people. They're essentially custodians of other people's investment accounts. And for a TFSA or RRSP, for these types of sort of registered investments, while you can direct what goes on inside your accounts, technically the funds need to be held by a separate legal entity. And that's where these specific trust companies come into play. So In Canada, there are several of them: Olympia Trust, Western Pacific Trust, Odyssey Trust, Computer Share. Those are some of the larger ones. But essentially, the way that it works is you work with them to actually have your TFSA or RRSP. And again, you can have as many TFSAs or RRSP accounts as you like. They are the ones who actually have the account. So you move your funds into your TFSA or RRSP with them. And they've also done the work to go ahead and verify the underlying private investment as being eligible for TFSA or RRSP investing, because private investments aren't automatically TFSA or RRSP eligible. And so each individual investment has to be verified by the specific trust company that you want to hold your account with. So even if you have an account, for example, with Western Pacific Trust, if the investment has only been verified by Olympia, you will need to actually open a second account with Olympia and then make your investment through the account at Olympia. It's basically a one-to-one matching.
Why can't I just use my TFSA at my bank?
That's a great question, and it's a slightly frustrating one. But essentially, the big banks are able to have TFSAs and RRSPs because they also have a trust company somewhere in their network of subsidiary businesses that they own and control. And the large banks are generally incentivized to ensure that the investors who are their clients are only investing within their umbrella of products. So you might notice if you're with TD or Scotia or RBC, and you have an RSP or a TFSA with them, and you have a financial advisor who's helping you choose the investments, all of the mutual funds or all of the ETFs that you're investing into, where they're choosing for you, will most likely be RBC owned or TD owned mutual funds. That's the same thing. So you've got your RBC checking account, you've got your RBC credit card, you've got your RBC TFSA, and you've got your RBC mutual funds inside your RBC TFSA. It's designed to sort of keep everything united, and it makes it easier for their advisors to understand the products because it's owned by the same company. Those same trust companies are typically not willing to do the work to go ahead and verify and take on the responsibility of verifying different distinct private investments as being eligible for TFSA or RRSP accounts. It's a lot of work to sort of go and set one up, and the vast majority of their business is designed to be invested into public available investments. And so the large banks are typically not willing to do the work to go ahead and verify the private investments as being TFSA or RRSP eligible. That means you as an investor can't hold them in that account because they're in charge of what they're willing to verify or not verify into your TFSA or RRSP at RBC.
Are all private companies TFSA RRSP eligible?
No, not all private companies are TFSA or RRSP eligible. Essentially, there's two different types. One is basically an operating private company. So this is a situation where it's a Canadian owned and founded business, and the company has employees and expenses and revenue, and it's actually engaging in operations. Then working with the right tax professionals, that company can be confirmed as TFSA RRSP eligible. The other option is something called a mutual fund trust. So limited partnerships, which are the basis for most funds, are tax flow through vehicles. So any tax, either tax on income or tax losses from expenses, are automatically flowed through the entity and passed on to the underlying investors. For that reason, a limited partnership can't be held inside a TFSA or RRSP. And so a structure called a mutual fund trust is created. Essentially, there's a trust created at the top. This is different than a trust company. This is a trust as a legal entity. Think trust fund, kids. It's a distinct legal entity that controls funds. This trust exists at the top, and then it invests the money of the people who invest into the trust into the actual underlying fund, which is a limited partnership. So you as an investor would be investing into the trust, and then the trust would invest into the limited partnership. This is the structure for most mutual funds that you've invested into without necessarily realizing it. And this is the same structure for many REITs, real estate investment trust. So it's a pretty standard structure used in the investment space. So mutual fund trusts can also be confirmed as being TFSA RRSP eligible, even if they're private mutual fund trusts. So it either needs to be operating small business, a corporation, or it can be a mutual fund trust to be sitting inside a TFSA or RRSP.
As an investor, what are the typical fees I should expect from a trust company to invest privately?
Yeah, so if you're using a trust company like Olympia Trust, Western Pacific Trust, Odyssey Trust, for example, and they've gone ahead and verified the investment that you're looking to invest into, they verified it as being eligible for investment via RRSP or TFSA, you are going to have to open an account with them and then make the investment through that new account. Like any business, they have to be paid for their services. And so most of these institutions charge a few different fees. They typically have a flat annual fee, usually between $150 and $200 a year plus tax. They also have a transaction fee, usually somewhere between 80 and 100 plus tax. There may also be some processing fees, usually between $20 and $30. And that is what you'll need to get your funds into the investment. So you'll have your annual account fee plus your one-time transaction and processing fees to make the investment. You'll be charged the annual account fee, of course, on an annual basis. And then after your investment is complete, the money will flow back into that same TFSA or RSP, and you can continue investing from there. If you want to withdraw the funds from the TFSA or RSP, you'll probably also be charged a withdrawal fee of some sort. Each of these different firms will post their fees on their website where investors like yourself can review and understand what those will look like. But it's important to sort of budget those into your investment decisions. Given the fees are flat, when you have very large or many investments that you're making from these accounts, then the fees can easily be distributed against such a large investment and large potential return. But if you're looking to make very small investments as you get started in the private space, it doesn't often make sense financially because the benefits, the tax benefits you would get by not paying the income tax on the funds that you wanted to invest and then putting them inside one of these RRSPs and then paying the fees every year, the cost of the fees might end up being greater than the tax savings you're getting by, for example, putting the investment in the account to begin with. We typically don't recommend making your first investment or setting up a new account to make a private investment if the investment itself is less than $10,000, just because the fees will start eating up any potential returns that you would be getting from that investment.
What is the EMD's role in the TFSA and RRSP investing, and why can't I purchase the investment myself through the trust company directly?
It's a really good question, Ryan. Essentially, the responsibility of the exempt market dealer is to work with you, the investor, to help determine your suitability and eligibility to make an investment. In the vast majority of private investing scenarios, you need to go through the exempt market dealer. So the exempt market dealer can help make sure that it's legal and you've completed the right investment paperwork to actually make the investment. When you're investing through a regular TFSA or RRSP publicly, you don't actually realize it, but the bank is also doing the same thing. The bank is doing a suitability assessment on you to determine the types of investments that you can or cannot make through a TFSA or RSP. For example, you cannot buy regular mutual funds directly yourself, right? You can buy exchange traded funds directly through a self-directed account, but you can't buy mutual funds. You have to go through a mutual fund dealer because their job is to help determine the suitability and eligibility of you for different mutual funds. That's what their job is. They're not necessarily a financial advisor in the same way, but that's their job. Also, other things that you can buy directly, like options, puts, calls, swaps, those are available to people through self-directed trading accounts, but your account does not automatically be set up to allow you to do that because those types of investments are higher risk. And so for you as an individual, you actually have to apply to the bank or institution to get approval to have an options trading account. They have to do a suitability assessment and determine that that's okay for you to do. So you can't, even in the public space, automatically just go and invest in whatever you like. The same applies in the private space. The exempt market dealer is that middle person to help make sure you're eligible and able, and it's the right fit for you to invest into the different private investments that are available. The trust company is just like the location where your investments are stored. Let's say you just go to the trust company directly and say, oh, I want to put $100 into fund XYZ that's on their shelf. You haven't actually made any investment through doing that. You've directed them that that money eventually is going to be going to that fund, but the money will not be released from the trust company to the fund until all the requisite paperwork is completed. And the paperwork is not completed with the trust company. It's completed with the exempt market dealer. When you go and you make your investment through the exempt market dealer, you're signing a bunch of forms. Those forms are primarily the subscription agreement. So this is the actual legal agreement where you are buying the investment. This is the most important single agreement when it comes to making your investment, because this is the agreement where that investment is actually made. If you haven't signed a subscription agreement, you have zero legal proof that you've made an investment of any kind. So that subscription agreement is very important. There's also a number of essentially risk acknowledgement forms and other documents in the investment package alongside the sub-agreement, which are required by law. The company, the fund, or whatever that you're investing in, they're required, as well as the exempt market dealer, to collect these forms and have you complete them as part of the investment process. And they have to file those after they've raised capital and done what's called a closing. So every month, they're having people come and invest. At the end of that month, they have to go and file all those documents with the regulators. If they haven't collected those documents, they can't file properly and they're not legally allowed to accept your investment. So in terms of the flow, if you were to go just to the trust company and only sign documents there, you haven't actually made the investment. It's basically like saying to a friend, hey, I'm going to go on vacation. Can you watch my house? Somebody's going to come pick up my car and take it to the mechanic to do the oil change. You've let the house sitter know that somebody's going to come take your car, but the house sitter is not the one driving the car to the mechanics and doing the oil change. It's the exempt market dealer and the fund who together go to the trust company, actually come as those individuals picking up the car and saying, hey, we're here to pick up the car and take it to get the oil change. So you need all of the pieces to be working together. At Equivesto, to try to make your life a little bit easier, we've actually embedded all the documentation from the trust company into the Equivesto process. So rather than signing the investment documents with Equivesto first and then going to the trust company to sign some more documents again to tell them, hey, somebody's going to come pick up my car, you can do the entire process, all of the documents with Equivesto at one time, and then we, on your behalf, go to the trust company, give them all the documents and say, hey, this investment is going to be made at the end of the month into these accounts. Please be ready. We even do that to help set up new TFSAs, RRSPs, or other accounts so that you as an investor are able to have one location where you have to complete all your paperwork, and then we handle the rest to try to give you a more seamless experience.
What is the main difference between a direct cash investment and an RRSP TFSA investing?
Yeah, from the investor perspective, the main difference between a direct cash investment and a TFSA or RRSP investment is going to be the time and the flow of the fund. If you as an investor are making a direct cash investment, you'd come to your investment platform, your EMD, like Equivesto. You would sign up, create your investor account. You'd choose the amount you'd want to invest, sign the documents, and provide your bank account details. And Equivesto will automatically pull the funds from your account the next day. So we get the funds from your bank account, we put them in our trust account, and then at the end of the month, we release the paperwork and the funds to your investment, and we handle that entire process for you. The investment is made within the same month that you signed the documentation and we collected the funds from you. It's all very sort of seamless and done quite quickly after you've signed the paperwork. Now, if you're looking to make the investment through a TFSA or RRSP and you don't already have, for example, an account at Olympia Trust with the funds sitting inside that Olympia Trust account, what is going to happen is a new account is going to have to be created for you at Olympia Trust, but also paperwork will have to be filled out to go to your existing TFSA or RRSP, let them know you're taking the funds out, move those funds from your existing TFSA RRSP over to the Olympia Trust account. And then once the funds arrive there, then at the next closing after that, that's when Olympia Trust or the trust company will release those funds, if they have the okay from the EMD and the company, to the company to actually make the investment. Unlike sending an email transfer or something super easy, moving the funds from one trust company to another, one financial institution to another, is actually quite slow and can be delayed. We usually tell people to recommend expecting at least 1 month for the transfer process. And if there's anything incorrect in the transfer forms, the whole process has to start again. So if you're showing up to Equivesto, for example, saying, hey, I want to invest in fund XYZ, I want my investment to go in this month, but my money is right now in my TD RRSP. And let's say we're in the month of October, the funds will probably actually arrive and be invested not at the end of October, but at the earliest at the end of November. But it could even be at the end of December when your investment actually gets made. It really depends on how long the process takes for Equivesto to have you actually sign the investment documents, and then we submit those to Olympia. We work with Olympia to have them reach out to, for example, TD Bank, and then TD Bank has to slowly release the funds to Olympia. We have to confirm they've arrived, there's no problems, and then proceed with the investment process. So at Equivesto, we try to do everything we can to take that hassle off of your hands and assist with that. So that's why we have all the paperwork completed with us as part of the Equivesto process. We then submit that to Olympia, and we work directly with Olympia to manage the whole transfer process as seamlessly as we can, so that when it is arriving for your investment and when you want to make your investment, it feels like you've just gone to Equivesto and then everything's been taken care of.
Why is it beneficial to invest in a private company via TFSA or RRSP?
Well, this isn't individualized personal advice. Please speak to your specific licensed professional about that. But TFSAs and RRSPs, of course, allows you to either defer or avoid taxation on the investments that you make. This can have obviously an immediate effect where you're not being taxed sort of 20, 30, 40% on the taxable amount of your returns, but it can also have a knock-on effect when it comes to compounding. So if you make an investment and the investment pays off in 5 years, you get the return without tax, you now have a larger amount that you can invest again, and that can add up year over year over year over year. So when it's finally time for you to retire, the impact of having more funds available each time without paying taxes on them can be quite exponential after 20 or 30 years of investing.
When does it not make sense to invest via TFSA or RRSP?
Because investing privately via TFSA or RRSP comes with account costs and fees from the trust company, and those fees are typically flat fees. They're not percentages. Smaller investments, as a result, the fee ends up being a much larger percentage of the overall investment. So because of the average size of the fees for each investment, and some of them are annual fees, we typically don't recommend clients invest through a new RRSP or TFSA at one of these institutions if the investment they're making is less than $10,000. And that's really because the tax savings you're getting by investing through a TFSA or RRSP, the dollar amount that can be calculated of those potential tax savings ends up being less than your initial transaction fee plus the annual account fees on your account, not to mention any potential withdrawal fees at the end. So it's important to sort of keep in mind there's really a tax benefit purpose for using those funds in the RRSP, and the fees associated with those accounts can start to eat away at those potential tax benefits. So if it's your first time opening a private TFSA or RRSP, if the investment is less than $10,000, we typically don't recommend doing that, as it's not necessarily going to be worth it to you from a tax savings perspective.
What happens post-investment? Where do I go view my private TFSA?
Perfect. Let's say you've made an investment through Equivesto and Olympia Trust. There are two locations where you can go to see information about the transaction that you've made. So Equivesto has a record of the transactions you've made, so the documents associated with the transaction, the amount spent, everything like that, how you qualified. But Equivesto doesn't maintain ongoing information about how your investment is doing after you've made the investment. That is where you would need to be going to the Olympia Trust account. So your Olympia Trust online account has a record, of course, of the transaction you made, but also Olympia Trust is going to be where you're getting the ongoing updates sort of every quarter or every year on the value of your investment. And when, of course, the investment is paid out, the funds will flow back into your Olympia Trust account. And so you can see them there and continue investing from there. Equivesto is where you go to purchase and make new investments. Your Olympia Trust account is where you go to review the current funds in your portfolio inside your TFSA or RRSP.
And final question, where can I learn more?
Please visit the Equivesto Learning Center. That's equivesto.com/learn. There's so much information and videos there. We have miniature courses on investing, on how to set up companies to raise capital via TFSA RRSP. We have walkthroughs of the documents that you're filling out, how you complete an RRSP or a TFSA new account form with Olympia Trust. We manage the whole process. You can also send any questions to invest@equivesto.com, and one of our dealing representatives will be happy to address them for you.
All right, and that wraps up investing via registered funds into private companies. Thank you so much for your time, and we'll catch you in the next Co-Founder Chats.
We're here to help you navigate this space, and we know it can be a little bit confusing. We're doing our best to make it a little bit more accessible and a bit more straightforward. If you have more questions about how to set up your portfolio or the process of making an investment, please feel free to reach out to Equivesto. You can reach out at support@equivesto.com, or you can hit us up in the help chat on the website directly. Thank you.